With spring upon us and new buyers out looking for houses, I thought today might be a good time to review the basics of what lenders look for as they decide to approve or deny mortgage applications. For many, many years, I have heard them called the 4 C's of underwriting: capacity, credit, cash, and collateral. Guidelines and risk tolerance change, but the core criteria do not. First, let's explore capacity. Capacity is the analysis of comparing a borrower's income to their proposed debt. It considers the borrower's ability to repay the mortgage. Lenders look at 2 calculations we call ratios. The first is your housing ratio. It simply is the percentage of your proposed total mortgage payment, principal and interest, real estate taxes, homeowners insurance, and if applicable, flood insurance, earthquake insurance, and mortgage insurance like PMI or FHA MIP, divided by your monthly pre-tax income. A solid housing ratio, often called the front-end ratio, would be less than 28%. Although many times loans are approved at a significantly higher number. That's because your front-end ratio is looked at in conjunction with your back-end ratio. The back-end ratio, referred to as your debt ratio, starts with that mortgage payment calculation from the housing ratio and adds to it your recurring debts that would show up on your credit report, such as auto loans, student loans, minimum credit card payments, etc., without taking into consideration some other debts like your phone bills, utility bills, cable bills. A good back ratio would be 40% or less. However, again, many loans are granted with higher debt ratios, understanding that every application is different. Income can be impacted by overtime, night differential bonuses, job history, unreimbursed expenses, commission, as well as other factors. Similarly, how your debts are considered can vary. Consult an experienced loan consultant to determine how the underwriter will calculate your numbers. So the second C, credit. Credit is the statistical prediction of a borrower's future payment likelihood. We know that as your FICO score. By reviewing the past factors, payment history, total debt compared to total available debt, the types of monies, revolving credit versus installment debt outstanding, a credit or FICO score is assigned to each borrower, which reflects the anticipated repayment. The higher your score, the lower risk to the lender, which usually results in better loan terms for the borrower. Scores below 620 are difficult, though not impossible. Scores from 620 to 660 are mediocre. Those from 660 to 720 are considered good, and above 720 are very good. Your loan officer will look to run your credit early on to see what challenges may or may not present themselves. Third factor is cash. Cash is a review of your asset picture after you close. There are really 2 components, cash in the deal and cash in reserves. Simply put, the bigger your down payment, the more of your own money at risk, the stronger the loan application. At the same time, the more money you have in reserve after closing, the less likely you are to default. 2 borrowers with the same profile as far as income ratios and credit scores have different risk levels if one has $50,000 in the bank after closing and the other has $50. There is logic here. The source of your assets will be examined. Is it savings? Was it a gift? Was it a one-time settlement, lottery, victory, bonus? Discuss how much you have and its origins with your loan officer. And the last C, collateral. Collateral refers to the appraisal of your home. It considers many factors: sales of comparable homes, location of the home, size of the home, condition of the home, cost to rebuild the home, even rental income options. Understand the lender does not want to foreclose. They are not in the real estate business. But they do need to have something to secure the loan against in case of default. In today's marketplace, appraisers tend to be conservative in their evaluations. Appraisals are really the only one of the 4 C's that can't be determined ahead of time in most cases. Now, each of the 4 C's are important, but it's really the combination of them that is key. Strong income ratios and a large down payment with strong reserves can offset some credit issues. Similarly, long and strong credit histories help higher ratios, and good credit and income can overcome lesser down payments. Talk openly and freely with your loan officer. They're on your side, advocating for you and looking to structure your file as favorably as possible. This is Ron Siegel, and I'd be happy to guide you through the mortgage process as your mortgage advisor or backup consultant. All you need to do is contact me.